Today, we've got an absolute gem for you, straight from the legendary Peter Lynch on how to make millions in a stock market crash.
The small investor has been convinced by the media, television media, that they don't have a chance. That the big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks.
This captivating piece of advice comes from a man whose name is synonymous with stock market success. For those who are unfamiliar with Peter Lynch, he was the manager of the illustrious Fidelity Magellan Fund from 1977 to 1990. During his tenure, the fund's assets grew from $20 million to a staggering $14 billion, making it the best-performing mutual fund in the world.
And this is the kind of stock people like to own. This is the kind of company people adore owning. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger mega flop or a smaller mega flop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. If you don't understand it, it doesn't work. This is the single biggest principle. I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle.
Known for his practical, common-sense approach to investing, Lynch has inspired a generation of investors to take control of their financial future. Now let's dive deep into his unique, game-changing strategies that have the potential to transform your approach to investing. His wisdom on capitalizing on market is invaluable, especially in today's volatile economic climate. In this video, we will dissect Lynch's tactics, detailing how they can be applied in the real world to yield astonishing returns.
I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet.
Lynch's perspective on the stock market is not just insightful, but also empowering. His strategies are designed to help every investor, regardless of their experience level, to weather any financial storm. So, get ready to alter the way you think about investing and start making smart decisions that can lead to financial freedom. If you're ready to supercharge your investing strategy, you're in the right place. Peter Lynch, the maestro of the stock market, shares his invaluable insights on making millions during a stock market crash. Many know him as an unparalleled investor with a reputation for turning a profit even in the direst of economic circumstances.
So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Economics to me is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancies. These are facts. There are economic facts and there's economic predictions. And economic predictions are a total waste. And Interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know.
Lynch, with his knack for finding undervalued stocks and predicting market trends, consistently outperformed the broader market for over a decade. Peter emphasizes the importance of understanding the companies you invest in. Blindly investing because a stock has dropped is a risky game. Without understanding the business, you'll be adrift when its value plunges further. The secret lies in knowing your investment's purpose. Many fall into panic-selling traps when they lack this crucial knowledge. Effectively, weathering market declines, according to Peter Lynch, hinges on a simple rule. Know what you own, understand the business, and take advantage of market declines.
You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
It's crucial to comprehend the business, not merely the stock price. Let's discuss volatility. Peter Lynch, a seasoned investor, cherishes it. He recollects the 1972 Taco Bell event where stocks fell from $14 to $1. Despite the plunge, his perseverance paid handsome dividends. He affirms volatility is key and should be welcomed with insight. Crucial pointer, understand your assets, particularly amidst market slumps. So volatility, Peter Lynch is a fan.
Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You could have bought Walmart 10 years after they went public and made 35 times your money. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this.
He notes that corporate profits usually increase by approximately 8% annually, meaning the market doubles almost every 9 years. Lynch's primary advice is to thoroughly comprehend your investments and always maintain a long-term perspective.
Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know,
It's not about timing the market, but rather about time spent in the market that yields returns. Lynch's wisdom is timeless and universally applicable. Lynch's time-tested investing thesis has outlived decades of economic turbulence, political upheavals, and changing market dynamics.